Hello, cryptocurrency enthusiasts and investors. Welcome back to our channel. Today, we're diving into a game-changing development in the world of Bitcoin and digital assets, the potential approval of a Bitcoin exchange-traded fund, ETF, by the SEC. Recent months have been abuzz, with news about financial giants like BlackRock, Van Eck, and Fidelity Investments seeking approval to launch their own Bitcoin ETFs. The question on everyone's mind is, what could this mean for the world of cryptocurrencies? Today, we're here to explore the potential consequences of the SEC giving the green light to a Bitcoin ETF. We'll break down what a spot Bitcoin ETF is, how it works, and the pros and cons of this revolutionary investment vehicle. A spot Bitcoin ETF is a groundbreaking investment vehicle that opens the door for everyday investors to participate in the price movements of Bitcoin within their standard brokerage accounts. What sets it apart from futures-based Bitcoin ETFs is its unique approach. It directly invests in real Bitcoins as the underlying asset, rather than relying on derivative contracts tied to Bitcoin's price. While futures-based ETFs derive their value from futures contracts linked to Bitcoin, spot Bitcoin ETFs own and secure actual Bitcoins. This direct ownership offers investors a clearer and more intuitive path to Bitcoin price exposure, simplifying the investment process. The regulatory approval of spot Bitcoin ETFs is a pivotal step towards making Bitcoin more accessible and accepted as an investable asset in traditional financial markets. It's a game changer that has the potential to attract mainstream investors and redefine the landscape of cryptocurrency investments. Spot Bitcoin ETFs operate by securely storing actual Bitcoins in a digital vault managed by registered custodians. This ensures the safety and security of the underlying assets. These ETFs aim to replicate the price of Bitcoins in the cryptocurrency market. To do this, they purchase Bitcoins from existing holders or through authorized cryptocurrency exchanges. The acquired tokens are then stored in a digital wallet with multiple layers of security, including cold storage to mitigate risks like hacking. To provide investors with exposure to Bitcoin's price, spot Bitcoin ETFs issue shares that correspond to the number of Bitcoins they hold. The share price should closely align with the prevailing market price of the cryptocurrency, ensuring that investors can track Bitcoin's performance. Authoriz participants, usually large financial institutions, play a crucial role in creating or redeeming ETF shares based on market demand. They help ensure that the ETF's share price aligns with the actual cost of Bitcoins, essentially arbitraging any price difference. Bitcoin ETFs offer a unique approach to Bitcoin investment with direct ownership of real Bitcoins. This direct exposure is more intuitive for investors, making spot Bitcoin ETFs a straightforward choice for those seeking to invest in Bitcoin. The straightforward nature of spot Bitcoin ETFs is a clear advantage, as each share of the ETF corresponds directly to a specific number of Bitcoins held. This transparency ensures investors can easily understand their exposure. In contrast, derivatives-based Bitcoin ETFs can be more opaque for investors. These ETFs derive their value indirectly from futures contracts, which can be influenced by various market factors beyond Bitcoin's spot price. This indirect exposure can add complexity and potentially increase investor risk. To put things in perspective, how will this thing benefit us all? First, convenience. One of the primary benefits of spot Bitcoin ETFs is their accessibility. They significantly lower the barriers to entry into the cryptocurrency market. Investors are spared the technical complexities of managing cryptocurrency wallets, navigating online exchanges, and handling private and public keys. This simplification of asset management makes it an attractive proposition for those accustomed to traditional investments. Second, liquidity. Spot Bitcoin ETFs make buying and selling Bitcoins easier through familiar brokerage accounts. The process closely resembles trading traditional stocks or ETFs, providing an intuitive transition for mainstream investors. Third, regulatory oversight. When you purchase your own Bitcoins, you might be doing so without the backing of clear, standardized regulations. In contrast, spot Bitcoin ETFs are subject to rules that ensure transparency and protect investors. Fourth, tax implications. In certain jurisdictions, spot Bitcoin ETFs could have tax benefits compared to holding cryptocurrencies directly. The tax treatment of ETFs is long established, and investors can know what their tax obligations will be from the start. On the other hand, let's get to know some disadvantages that come with the Bitcoin ETF. 1. Crypto volatility. The most obvious downside is the market volatility of Bitcoin prices, which could lead to significant financial loss. While the ETF structure simplifies aspects like ownership and storage, it doesn't insulate investors against the inherent risks of the cryptocurrency market. 2. Regulatory uncertainty. Another risk involves the lack of a clear regulatory framework to protect investors. Until more comprehensive oversight and standards are established, there remains a great deal of uncertainty about how risks like fraud, manipulation, and loss of assets will be treated. Cryptocurrency markets are still evolving, and future regulations could affect the performance of Bitcoin ETFs. Changes in tax laws, for example, could make crypto less attractive for investment purposes. 3. Security risks. The number of coins that spot Bitcoin ETFs would have to hold to be viable would make them attractive targets for cybercriminals. Bitcoin and other cryptocurrencies rely on digital keys and internet-based storage and transfer, while ETF managers use multi-layered security protections like cold storage and encryption. No system is impenetrable. Successful major breaches at spot Bitcoin ETFs could result in the theft of thousands or even millions worth of Bitcoins. Unlike cash in a bank, stolen Bitcoins can quickly be transferred anonymously and are almost impossible to retrieve. While rare, such cyber thefts have affected some cryptocurrency exchanges and holders, and an incident like this for a spot Bitcoin ETF would severely damage investor confidence and fund stability. 4. Management fees. While investing in spot Bitcoin ETFs would save you the time and costs of exchanging and securing Bitcoins yourself, these ETFs do charge management fees or expense ratios to cover operational costs, diminishing your returns over time. These fees can be higher than traditional equity ETFs because the ETF must also pay fees for exchanging and securing Bitcoins. 5. Tracking error. While spot Bitcoin ETFs try to mirror the performance of Bitcoin closely, tracking error differences between the ETF share cost and the value of Bitcoin can occur. Reasons for this might include liquidity in the market, delayed rebalancing of the fund's holdings, and management fees. A spot Bitcoin ETF indirectly affects Bitcoin in several ways. It can increase adoption among mainstream investors, potentially driving up prices. It validates Bitcoin in the financial system, boosting confidence. It creates more trading options, increasing volume and volatility. Additionally, it may reduce premiums for institutional investors, potentially affecting Bitcoin prices. While we eagerly await the SEC's decision, it's essential to stay informed and continue monitoring these exciting developments in the world of cryptocurrencies. This is a dynamic space, and we'll be here to keep you updated with the latest insights and updates. If you found this video informative, don't forget to like, subscribe, and share it with fellow crypto enthusiasts. Feel free to leave your thoughts and questions in the comments section, and stay tuned for more informative content. Thank you for joining us on this journey through the potential impact of SEC-approved Bitcoin ETFs.